What are the real opportunities in commercial real estate right now? I keep getting that question, and we're entering 2026. And then when I look at the commercial real estate market right now, operations wins the game. There's a lot of operators and owners of real estate who aren't operating the assets effectively, and it's competitive. So, looking for assets that are mismanaged, looking for storage properties that don't have the proper management, no website, apartment operators who aren't maximizing the value of their rents or marketing to keep attracting new tenants, small bay warehouses where small tenants under 2 or 3,000 square feet need an affordable place to do business, mobile home communities that don't have a good on-site staff, that don't have real operations or maintenance in place. These are opportunities where people that entered the market, they're investing in the category and at the same time don't know how to maximize value. And now they're feeling it. Without keeping occupancy high, without adding concessions or discounts on rent, without being able to serve the tenant or target the right tenant demographic, you're not going to survive in this market. So over time, I'm seeing more and more assets sell because of poor operations. So the opportunity for us right now is targeting these assets, building the relationship, and then getting it at a fair price where we're not forecasting in the future that we're going to be able to dramatically raise rents or fill it up overnight, but at the same time, be able to make little improvements by putting a manager on site, by marketing effectively, by working with the tenants that are there and giving them what they want by making improvements to the asset. Right now, there's a huge opportunity to buy at the right basis. So then as the economy gets better, or if there are fluctuations and it gets worse, we can endure the hard times and then over a 5 or 10-year period, be in the position to truly create generational cash flow that 5, 10 years from now, we'll be able to buy assets that you can no longer buy at this cost basis. And with the inflation of rents, have a durable asset that will continue to produce positive returns year over year with minimal competition because buying at such a favorable basis. What risks do I see in commercial real estate right now that most people aren't talking about? Number one, I'm seeing people still forecasting values in the future at extremely low cap rates. Apartment owners are valuing their assets at 4 or 4.5% cap rates, maybe even 5. And that may be the case for some markets. The majority of commercial real estate assets are going to be trading at higher cap rates over time as interest rates continue to go up and down. And we don't know what direction, but 5 years from now, we can't predict where interest rates are going to be. So it's important to forecast a reasonable interest rate in the future. Getting too aggressive on that exit price completely shifts the entire return profile on the investment. So rather than being aggressive and selling at an extremely high value, I think owners, including ourselves, should be very conservative and sober on that exit value. That way we buy assets that we don't need a compressed cap rate to get a high valuation in the future. We just need to operate the business effectively by serving our tenants, marketing the right way, and driving the rents up year over year. And then that way cash flow and durable multiple streams of income from multiple tenants ultimately will drive the value of the asset regardless if cap rates compress or not. And then we have an asset at a basis that's very durable and stable that will continue to cash flow long into the future. Other risks that I notice people aren't talking about in the economy right now is the chance of a true recession, maybe even a depression. And I'm not an economist. I have no idea what's going to happen in the future. And whoever says they do know, they're lying. But what I do know is that the average consumer is heavily under pressure. We're seeing it with all of our 20+ thousand tenants that rent storage, mobile home parks, small bay industrial. People do not have the expendable incomes they had in the past 3-4 years ago. Credit card delinquencies are high. Car payment delinquencies high. Even mortgage delinquencies are high. People are feeling the stress from the economy because it's not growing or growing at the pace that is needed in order to continue to drive value on investments. We're going to see many tenants that can't pay a rent increase or they can't spend the extra money to go into a bigger space for storage or for warehouse. And apartment rents, they're going to be tight because the economy essentially is not growing in the near future. So forecasting these large growth events is detrimental to buying a value-add asset. I think conservative underwriting is going to allow us to be sure to protect the downside first. That way, even without large rent increases, the stability of the cash flow will stay in place, and even building in a buffer where if you lose 10% of the revenue or you lose 10% occupancy, that you're going to be able to endure those times. So after the recession, that when rents do increase or inflation increases earlier than that, you're in a good position with real estate. In the short term, it's about enduring the hard times where there could not be growth. People have very short memories thinking real estate market always grows. It doesn't. There's times where it shrinks, and we're seeing that right now. It might not be dramatic, but it is not growing rapidly. So protecting the downside is the most important thing, and rent growth is very risky right now. If I were a brand new real estate investor today in 2026, where would I start? Well, where I would start in real estate investing is cash flowing properties. There's less and less out there, yet buying durable, diversified streams of income, cash flowing properties is exactly where I would want to be. Now, that takes so much patience because there's very little cash flowing commercial real estate or residential real estate out there. But having the patience to look at deals and pick a category, pick one category of real estate you're going to invest in and learn it better than anybody. I chose mobile home parks when I started because I saw there was an opportunity in the market where investors weren't buying them at scale. There was very few, if any, larger investors in the space that were competing in the same space I wanted to enter. Now that's past. There's a lot of mobile home park investors out there, and it's driven asset prices high. It might not be the best category to choose if you're starting out, but there is opportunity there, but you have to be willing to look at thousands of deals to find one. I really like small bay warehouses right now. They call them flex spaces, meaning it's flexible for retail, showroom, office, industrial. These industrial properties allow for all these different uses, and many businesses today need a flexible space to do business in. The studio I'm in right now is a flex property where there's office and studio in the front and warehouse in the back. And these types of assets have durable streams of income. And many different types of businesses need this type of space because it's affordable and it's flexible. It can be built out in a way that's going to be conducive for that business owner to run their business. And it's small. It can be 3,000 or less square foot spaces. So the net rent can be $2,000, $3,000, $4,000 a month instead of $10,000 or $20,000 a month. Also, a very trendy category right now is IOS, industrial outdoor storage. There's businesses that have large fleets of trucks, or there's trucking agencies with distribution or logistics that need to park their cars or vehicles or equipment in strategic places located off of major highways or major interstates. These assets are doing very well. I'm not positioned to invest in them, but if I were to start over, I would target a database finding these lots that have the proper zoning that are located off of highly trafficked areas that are in the middle of distribution routes going to different towns or cities or airports and ports, and then trying to buy those properties and working with brokers to be able to lease them up to IOS tenants. Also, if I was just starting in real estate investing this year, number one, I would pick less than 5 markets I want to focus on. Not only do you pick a category, but picking the market that you live in, if that's where you want to invest, and a handful more of markets because you really need to understand the market rents and understand the players. Brokers many times will control most of the transactions on the leasing side and on the sales side. You know, I'm a big proponent of going direct to the owner and inquiring if they would like to sell directly to me as the buyer. But at the same time, you want to know the brokers and you want to know that market information, where the areas are growing, where they're declining, and then what the typical cap rates would be for that market and the demand for the category in that market. I live in Las Vegas. Retail in Las Vegas is going very strong. It's a highly desired product type because Las Vegas's demographics has high population and a high demand for neighborhood services because there's lots of housing and apartments nearby. As a new investor, I would have to fully commit to this strategy of finding the owners, finding the rental rates, finding the areas where there's vacancy that I could improve the vacancy, and then fully commit to that strategy instead of the shiny object syndrome of trying to buy 5 different categories of assets in 15 different markets and being so confused and overwhelmed that I'm truly not getting an edge when I'm acquiring a commercial real estate asset. And that's going to really affect the returns, and it's going to be a lot of risk that I didn't mitigate for because I don't truly understand what I'm investing in. If I were starting out in 2026, I would also find a mentor, find someone that knows the category that you're investing in. And that doesn't mean that they're going to want to work with you. But the way I started out is I found a really knowledgeable mobile home park investor who was trying to grow and scale his business. And I was able to serve and add value to his company by going out and finding opportunities he was not seeing. So I was exploring the market, looking at every mobile home park I could find throughout 30 or 40 different states, showing them the opportunity, making offers on these parks, going directly to the owners, meeting with them, understanding what the lot rents are, understanding what the operating expenses and management looked like, and then in turn working with him to buy these assets and learning where are the pitfalls, where are the red flags, where are the time bombs, the things that are really going to affect the investment that I can't see because I'm brand new. But he's had 20 years experience that I could learn from. Yes, I left money on the table because I brought in a partner and he took the majority of ownership, but I learned to fight another day. I ended up generating some equity by being a partner, generating some fees for helping do all the work to acquire the deals and manage them, and then in turn be able to break off on my own. And I did this without blowing up my own portfolio because I was then able to learn the things I didn't have a clue of what to look for in any category that you enter into. If it's apartments, warehousing, mobile homes, storage, retail, office, industrial, all of it, there's going to be nuances of things you don't even know what to look for. So finding an expert, in my opinion, is the best way to learn. And the second best thing is at least find knowledgeable brokers or joining trade groups that know the asset category in and out, or even networking groups or masterminds where you can learn from the experts who are doing it and then be very picky and patient. If you do the wrong deal your first time, it can slow down your growth as an investor a decade, because I did it. I bought single family homes in Las Vegas from 2004 to 2008, and it wiped me out. And that set me back years. So taking your time and picking the right category, the right markets, and the right mentor is going to put you in the best position to build long-term wealth in real estate. So what's the hardest lesson real estate has taught me? Well, I've been investing in real estate for 20 years plus now. And the hardest lesson that I've learned is that real estate does not always go up. And impatience can be your worst enemy. Waiting and being patient and doing your due diligence, and even if you have to sacrifice 1, 2, 3 years before you buy the right opportunity for you, is critical to being successful in this industry, because markets can go down very quickly, they can lag, and it's a very capital intense business. So when I started out, that lesson of being patient also tied to going into a property with very little money and not having reserves. It is a very thin line to walk because you can run out of money so quickly on commercial real estate investments. Any unforeseen improvements, any decrease in occupancy, all require capital calls. And if you run out of money, you lose the asset. So luckily in commercial real estate, I've never lost the asset, but I have in residential. So the hardest lesson is, number one, being patient. No matter how badly you want it and you think emotionally you're involved and you want to do a deal, you have to wait and make sure, after all of your homework and diligence and hard work prospecting and looking at opportunities and talking to brokers and finding investors, is waiting for that deal you know in your heart of hearts that is the right one and not rushing the process. And the second thing is being undercapitalized, raising more money than you need, bringing in partners, even if you give up more ownership, having that available capital waiting there just in case things don't go to plan, because I promise 9 out of 10 times they're not going to go to plan. And you want to have those reserves so you can sleep at night, so you can execute on the plan. And then in turn, once you get through those problems and come out the other end, provide great returns to your investors, provide solid cash flows that will last for decades, because up front, you built the right foundation and you found the right asset and you prepared yourself to endure anything that happens. So what moment of my career in commercial real estate will I never forget? The moment in my career that I'll never forget is about 1.5 years into when I bought the property. I raised investor capital. I've been managing it myself. And I finally realized that I was not going to be able to turn this property around. All the time and energy and the money invested with my own money and other people's money, I was not going to be able to be successful on this property because it had all of the wrong attributes. It had the wrong tenant base, full of drugs, full of violence, not a lot of demographics, not a lot of population in the area. It was near an Air Force base, but it was far out, 45 minutes outside of Las Vegas. And it had a lot of deferred maintenance, but there was damaged mobile homes, there was damaged water lines and sewer lines. I was faced with the reality of having to find a solution to get out of this property knowing that I'm not going to make a profit. And the lesson that I learned from that was there's no giving up. It's not like I can just walk away. It's not only my money, it's someone else's money. Plus, I have my own credit on the line because I signed a guarantee on the loan. So no matter how good my intentions are or how excited I was about the investment, learning this lesson of staying committed and working there another year and a half to turn the property around, knowing there was no profits. Everything I did was just to secure and preserve the investment that I could. It was a big lesson because it's hard to work when you know you're even not going to make money. You're just protecting money. So in the end, I was able to find solutions to fill enough of the mobile homes, to repair the property enough, to be able to find a buyer who was willing to buy it at a fair price. And then I was able to talk to the mortgage owner about discounting their loan. It was a seller finance mortgage. They knew the property was in disrepair and it was really needing help. They were able to lower the mortgage amount, and I sold the property, taking a loss to my investors and losing my own capital. But in the end, knowing it was time to cut loose because it was the wrong property in the wrong market with the wrong attributes. All of it was off. And then going back to the investor over the next year and then paying them back their lost investment. I didn't have to do that. It's not a guarantee in the operating agreement or partnership that I'm obligated to pay them back. But knowing I made a mistake, I had to turn it around, and then finding a way with any of the income that I generated in the future to pay back that initial investment that they entrusted with me. So learning to work on something to fulfill a commitment, even when you know you're not going to make any money, was a major lesson for me. And then luckily, that investor ended up coming back years later and investing significantly more capital. But in the short term, they were not happy. They were not excited about potentially losing their money, but then having their investment paid in full, and then also seeing the work ethic and the character that I demonstrated to make sure that I fulfilled my commitment helped me grow with them over the last decade. And that was a huge lesson for me to learn as well, is just because it's in writing doesn't mean that you shouldn't do the right thing.